Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi friends, this is Aditya Vora here. Hope you guys are in festive spirits. While the last 2 years were dull when it came to the festive vibes and spending due to COVID, this year is going to be like the good old days. In fact, Ganesh Chaturthi and Diwali will have a lot of pent-up demand which will boost top lines and bottom lines of many consumer companies. I was reading somewhere that festive season makes up for more than 35% of your yearly sales and profitability of many consumer companies. All of us are big fans of McDonald's and Domino's pizza. Now, if most of the people around us prefer these QSR restaurants, is it a good strategy to buy the stocks of these companies? Common sense investing would definitely say yes. However, as an analyst, it is important to look at numbers and valuations. The problem with these mega brands like McDonald's, Domino's, Pizza Hut and KFC is that their P multiple historically have always been very high. As an analyst, what is important to figure out is whether these high valuations are justified considering the growth. In that endeavor, I thought of being ready with a list of stocks in the QSR space, which is the quick service restaurant space. After all, that is the sector I always have liked but never got a chance to buy as I could never agree with valuations. So let me jump directly to stocks as all the long-term gyan about penetration, consumer spending and per capita spending is known to everybody. And I am not here to sell a story but to purely talk numbers in context of valuations. In the end, it is important to understand which QSR stocks can do well and why. And if yes, are these stocks worth at the current valuations? So in this video, let's try to figure out whether the McDonald's and Domino's pizzas of the world are good for investors or not. What I have done is taken a bunch of stocks which broadly represent the QSR space and analyzed each stock briefly to understand where they stand on a valuation perspective. So here is the list of QSR stocks you should keep in your watch list, and let's start to analyze each of them on valuations. When you look at the above list, let's start with the method of elimination. Now the first stock to be eliminated is Restaurants Brand Asia, or what we call as the master franchisee of Burger King in India. There is no point looking at loss-making companies, and even if these companies are expected to make profits at a point in time in the future, it is difficult to predict when it will turn around. The master franchisee of Burger King in India, which is Restaurants Brand Asia or RBA, is a loss-making entity. So investing in Burger King stock is out of question, though you may want to try its Whopper collection of burgers. That is really nice. Another stock which can be eliminated in the restaurant space is specialty restaurants. The problem with specialty restaurants is that its performance over the past 10 years has always been dismal to say the least. While the company hasn't been able to scale up its brand or as a matter of fact make money for the shareholders. You look at any metric over a 5 to 10 year period, you will be thoroughly disappointed. Specialty restaurants on a 10-year time horizon has given you zero returns. Yes, I will say that one more time. Specialty restaurants over a period of 10 years has given zero returns. Let us look why that had happened. Net sales has grown at a disappointing CAGR of 8% over 10 years from 2011 to 2020. I haven't taken the 2021 period due to the COVID disruption where sales for dine-in restaurants were almost zero for half of the year. Even if you take a 5-year trajectory, net revenues have barely grown by 3%. And because of dismal sales, specialty restaurant turned into a loss-making company since 2017. The company registered a loss every year since 2017 till 2020. That's 4 consecutive years of losses. Now let us look at how efficiently the business is run, or in specialty restaurants case, how inefficiently the business was run in the past. The return on capital employed or ROCE over a period of 5 to 10 years has been negative 1% and 0.8% respectively. Now let us look at how shareholders are rewarded. The return on equity over the past 5 to 10 year period has been negative 10% and negative 3% respectively. You know, the problem with specialty restaurants is the constant capex it must incur while opening new restaurants, as it is in the fine dining space. The size, the decor, the maintenance of the restaurants brings down ROC as it is in capital intensive nature. It is extremely difficult to make money in such business model. Also, its flagship brand, which is mainland China, is not as strong a brand like a Domino's or McDonald's, leading to massive competition from the unorganized sector. After all, Chinese cuisine is price sensitive and it is dominated by the unorganized segment. It is extremely difficult to make a strong national brand. So now we are left with Jubilant Foods, which is Domino's Pizza, and Westlife Development, that is McDonald's. Now, as much as I am a fan of eating burgers from McDonald's, when I look at the numbers, the stock has never given me any confidence. While I agree the brand is extremely strong, but the stock at every level has always looked overpriced. Let me tell you why. To start with, Westlife Development, which runs the McDonald's franchisee in West and South, is in an aggressive store expansion mode. The management has set an ambitious target of adding 35 to 40 stores in FY23 and thereafter 200 restaurants in the next 3 to 4 years, which, if you break down on a conservative basis, adds up to 50 to 60 stores per year. In the past, the company has been adding only 25 to 30 stores per year. So let's broadly talk about numbers. Westlife Development closed FY22 with a net sales of 1576 crores, with roughly 326 stores in its books. That means every store did a sale of 4.8 crores on an average in FY22. Now, as per the management, it is expected to go on an aggressive expansion mode. So by the end of FY24, even if we assume 411 stores and take the revenue per store as 5.8 crores, which is 20% rise from the FY22 levels, we get a total sales of 2,384 crores. Roughly, on a net sales of say 2384 crores, even if you take EBITDA margins of 15%, which according to me is the best case EBITDA margin, the operating profit comes to 357 crores. A 5% net profit margin on net sales of 2384 crores is 120 crores of profit after tax. If you translate that, it comes to an EPS of 7.7 rupees. So, with the current stock price of 640 rupees per share, the FY24 price to earnings ratio on an FY24 EPS of 7.7 comes to roughly 85 times. I am talking about the best possible scenarios and still the PE ratio comes to 85 times 2 years forward. Also, what is important to note is that the return on equity roughly works out to 12 or 13%. The reason being the company will have to incur capex leading to low returns. That means subdued ROC for the next 2 to 3 years. Lastly, for Jubilant Foods, the story is the same with regards to valuations. However, the operating metrics and efficiency and performance ratios are way better than the peers. This is, in my opinion, the only company which has high valuations but shows strong revenue and profitability growth along with ROC and ROE of 20 to 25% plus on a consistent basis. The point I'm trying to make is that though Jubilant Food is expensive, superior operating efficiency along with strong growth trajectory makes it a stock to watch out for on corrections. In terms of valuations, Even Jubilant Food trades at a forward 2-year price to earnings of more than 60 times. However, the company has enjoyed an average 10-year ROE and ROC of 24 and 25% respectively. Also, the company has maintained its 5-year operating margins at 21% despite all the challenges. This shows the resilient business model. The reason why the ROC and ROE along with other financial metrics are so strong is the business model which it is focused on. The business model of Jubilant Food is focused more on delivery and less on dining. That means fewer overhead costs, lesser rentals and higher return on every rupee of capital invested by the company, unlike its peers which must have larger format stores, higher manpower cost and higher other expenses. So as much as I would love to have a burger or a pizza, the valuation seems excessive as of now. So guys, that was my take on the QSR space. Best of brands but very expensive valuations for now. Plus all the stocks have run up by at least 2 to 3 times over the past 2-3 years without substantial change in the financials. Thank you friends for watching my video and do let me know if you have any suggestions or comments.